positive outcome for the annual return. But thinking about managed funds, I want you to think about the possibility that while you may be thinking about only managing your own individual assets and moving your wealth forward independently apart from using anybody else's money, for some of you that may not be the case. Maybe you came into this mentorship with every expectation of learning to do that very thing. Well, it starts here. You have to have a realistic expectation coming in, and knowing that you don't need a whole lot of money. If you can show a consistent equity curve that's improving, very little drawdown, very infrequent, erratic or slow periods in your trading, that is very good for investors when they see things like that. And it doesn't have to be high rates of return, but having a steady increase of over a calendar year, that really attracts investors. You have no idea how much money is sitting out there just waiting for people to say, hey, look, I'll take that money and control it for you and turn a profit. Now, you also don't need to use the entire equity base that you start with. Many times, $10,000 trading account, and they assume that they have to maximize every possible dollar in that account to get a respectable rate of return. And I don't teach that. I actually have a very conservative approach. When I'm trading, my view is I don't want to allocate every possible dollar to the marketplace. What I do is I limit my allocation to only 30% of my total equity. And it may be shocking to some of you, but it's the truth. So let's say, for instance, I have a $100,000 trading account. Or let's say you have a hypothetical $100,000 trading account. That means I'm only going to be using $30,000 to meet whatever margin requirements or trade parameters that I use for that trading. In other words, if I'm going to be doing a percentage basis of my equity, and let's just say, for instance, that I'm going to be using the standard in the industry of 2%, that means I'm going to be using 2% of 30,000, not 2% of 100,000. And the reason why that's done is because I'm never going to have to worry about margin calls. I'm never going to be over leveraged. I'm never going to have wild dips in my equity, but I can still manage to carve out a very nice equity curve, even just using 30% of my equity. Investors like to see that. They like to see that you're not 100% exposed. They like to see that, having a good reserve of cash in the account. That way you always have opportunities that you can still take, that if they're really too good to pass on, you have never extended yourself too much and spread yourself too thin. So that way you always have an opportunity to take something that may otherwise not have been on your radar screen. Something comes up in the charts, something comes up as an opportunity. You always have equity at your disposal to take advantage of that move. So what you're doing, again, is you're determining your maximum risk exposure in a percentage basis on 30% of your equity. So you're really, really, really drawn down in the terms of risk. You're not maximizing the risk for maximum return. You're looking for a very low-end risk exposure with the expectation that you're going to have consistently pulling in percents of return that are respectable over a calendar year. Again, you're going to ideally set 1% as the most risk per trade. That means 1% of 30% of your total equity base. Okay, so you have $10,000 in your account, and you're going to be using 30% of your account. That means your account trading is going to be based on $3,000, not $10,000 over leveraged, not looking for the maximum return. You're looking at only using $3,000 for your trading account to be meeting those margin requirements for your trades. 1% of that is going to be $30. So $30 is your total maximum risk per trade. And I already know what some of you are thinking, Michael, I can't get rich doing this. And that's right, you're not going to get rich right now. You're not going to get rich tomorrow or next month. but you're not thinking like that right now. I want you to consider, and I'm not trying to force you into managed funds, but I'm trying to broaden your perspectives, okay, on a lot of things, and allow yourself the opportunity to even just think about the possibility. And again, I personally know from experience it's not fun